Well, I mean, digital commodity might not sound like much, but it when you go down to the next round, which is like it's a Ponzi scheme or it's a scam or it's tulip bulbs, right? The difference between tulip bulbs and digital commodity is a zero versus a one. And I have said before, and I would repeat it again, if it's not going to zero, it's going to a million. Right? What's the materiality of EDX versus all the other crypto trading? I don't know, but EDX did come live in the same week when this news is breaking. And what happened in rapid succession is like 4 or 5 other Bitcoin spot ETFs get refiled. So if you step back and you look at this from the point of view of an indifferent investor or an indifferent industry watcher, the conclusion would be, it looks like a spot ETF probably will get approved. There's massive political pressure to approve one. The circumstances have changed, and now there's a way for the SEC to approve it without backtracking on its previous legal and policy guidance. Certainly, there are a lot of Wall Street entities that have a vested interest in seeing this happen. If you're an institution, one way to get Bitcoin exposure is to buy the underlying asset, but there have been challenges with finding the right exchange to buy it on and the custody arrangement. And so a simpler way to do it is to buy the spot ETF. There are trillions of dollars of capital that is required to invest in a security that trades in these compliant forums is understating the obvious. It's tens of trillions of dollars. So there's a lot of capital that can't buy the Bitcoin or self-custody the Bitcoin. They don't have the charter. Maybe it's against tax code. Maybe when they raised $10 billion from public investors, they raised it to invest in securities, but not invest in commodities or property. So the spot ETF availability is a major milestone for institutional adoption. The approval of a spot ETF is a major milestone in regulatory clarity, which is tantamount to an endorsement, right? The engagement of Fidelity, Citadel, and BlackRock and Schwab in this exercise is, I mean, Charles Schwab is literally synonymous with Wall Street, like 100 years of Wall Street. So what you have is Wall Street coming together to offer securities and exchange services and indirectly custody services for mainstream investors. And if we look out about 12 months, if I was saying, well, what are the key milestones to drive mainstream adoption of Bitcoin? Well, one of them clearly is a spot ETF. The second is the designation that Bitcoin is an asset class, right? The recognition of it as a legitimate commodity. It's a big deal, you know. And when Jerome Powell says it's not going away, when Gensler and when the head of the SEC and the CFTC both say it's a digital commodity. Well, I mean, digital commodity might not sound like much, but when you go down to the next round, which is like it's a Ponzi scheme or it's a scam or it's tulip bulbs, right? The difference between tulip bulbs and digital commodity is a zero versus a one. And I have said before, and I would repeat it again, if it's not going to zero, it's going to a million. It's either nothing, right? If it's nothing, then it's getting scrubbed out and banned. And of course, we now know that it's not getting banned, right? There's no way that Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, Credit Agricole, Banco Santander all decide they're interested in this, right? They're not endorsing a tulip bulb, right? So once you go from 0 to 1, then the question is, okay, well, it's an asset class. If it's not going away, then what's it worth? Well, it's worth 1% of the assets in the world. So 1% drives it up by a factor of 10 to 20, right? Once you get to a 1% exposure. So the recognition as an asset class is a big deal. The availability of a spot ETF is a big deal. The the normalization of accounting via fair value accounting, which is the FASB initiative, it's another big deal. And then the halving, right, in less than a year is a big deal. So those are 4 pretty serious milestones that we're staring at right now. And I think, Wall Street and the general community is kind of just internalizing this all in a short period of time. And that's why the bullish outlook.
But the average, the normal person in the US making $60,000 a year, I like a good beer, saving up for a jet ski, got a wife, soon to be wife at home. How can I best benefit from Bitcoin?
Well, I think the best way to think about that question is to consider the alternatives people have. So you're a normal person and you want to save money for retirement or to give to your kids. So you put it in a savings account, you get 5% interest. The monetary inflation rate is 7 or 8 or 9%. You got a negative real yield of 3%. If you end up with a negative real yield of 3.5%, then over 100 years, $1 million saved is worth $30,000. Okay, and so for the average person, saving money in bonds with a 3.5% or 4% interest rate when the currency expands at 7 or 8, that's a losing proposition. You lose 97% of your wealth over the course of 3 generations. So clearly bonds don't work, right? And savings accounts don't work. So the next question is, do I just put all my excess money in the S&P index? Well, traditionally the money supply in the US is expanding at 7% and the S&P index is going up at 7%. So if you save $1 million over the course of your life and you put it all in the S&P index, then in 100 years, it'll be worth $1 million. So that's wealth preservation, but you're not doing any better than that. And that just kind of assumes that, that the S&P 500 is going to be relevant for 100 years and you can stick around the country. But it's like treading water. The next issue is, well, so what I put in real estate? If you buy real estate, you're an average person. Can you buy a building? Probably not. Can you buy a warehouse? Not easy. Maybe if you're a rich family, you buy warehouses, right? Rich families buy warehouses, city blocks, and buildings, but the middle class person doesn't. So how do you buy $4,000 worth of a building? Can't. Okay. So the issue there is your property rights are inferior when you're buying shares of stock or a security versus the underlying property. If you own the building, you can mortgage the building, sell the building, upgrade the building, build 10 floors above the parking lot that the building has. You can develop the building. When you own a share in a REIT that owns the building, like you own 1/100th of the building, you don't have any of those rights. You can't do anything to the building. You're just along for the ride, getting 1/100th of whatever cash flow the general partner decides to distribute to you. And if they make stupid decisions, you're stuck with them, right? You don't have any property rights. You're inferior in your economic rights. So owning shares of a REIT to get property for 100 years, not a great idea. And that leads us to the problem of securities. What is the problem of security? So you have some money, you invest it in Apple stock or Amazon or Facebook or Google or a REIT that owns a building. The dilutive problem with securities is there are risk factors. First of all, there's a management team. They're going to take 1% every year. They're not doing it for free. They're charging you to manage the company or the building, right? And if you're lucky, that's only 1%. You want to see that in action? Just go look at any ETF. The ETFs charge 90 basis points. If you want to put money into a Bitcoin, BITO or whatever, they'll charge you 90 basis points just as the management fee. So about 1%. What's the cost of 1% over the course of a lifetime? An infinite duration asset, you would basically multiply it by 20, 25. So it means that when I charge you 1% to manage your $1 million, I'm taking 20% of your money. Okay. I'm taking 20% of all your wealth to charge you 1%. So that's only the first problem. It turns out that when you run a company, you also have you have the risk of labor, right? Your company may unionize. So you've got labor expenses. And what happens to the equity value when the company unionizes? Well, the union just takes all the profits. And the equity values of those companies start to trend towards zero. So labor is another risk. The third risk is your competitors, right? Your competitor may come up with a better product and you end up like Yahoo squeezed out or AOL squeezed out by Google. Well, then your stock's going to zero, right? I mean, how many companies actually had a competitor? Xerox, Kodak, world's full of great companies. Where are they today? They end up getting squeezed by competition. The fourth issue is technology, right? You may just get obsolesced, right? Maybe you own natural gas fields or oil fields and someone creates nuclear power plants and they don't need your oil anymore. Or maybe you sell the world's greatest chemical cameras and people don't need cameras anymore. They have digital cameras, right? There's always that kind of risk from technology. And then there's execution. Maybe you just don't ship the iPhone 47 to be that good, right? Maybe the iPhone 13 is good and the iPhone 15 is not good, right? And the world's full of examples of that, like Firestone tires or something, and I ship a tire and the tire blows out, and now people stop buying my tire. Or New Coke. Remember New Coke is a product launch that didn't work out well. So when you're investing in a company, you're not just getting a pure investment. You're actually getting an investment in an asset, but you're getting hammered and diluted by force majeure, by bad weather. Yeah, you might get a war. You might get a tariff or a trade war. Like we just decided to put a tariff of 20% on all Chinese imports. Oops. If you had a factory in China, what happened there? And then maybe you get a real war where someone just impounds your ship or blows up your factory. That happens too. We have real wars all the time. Imagine that you own a bar of gold in the bank in your city. What's the likelihood that you still have it 100 years later? Imagine you have a building in a major city in the world. Imagine you still have it 100 years later. Would you want to own a building in Russia, in Moscow, in Kiev, in Tokyo, in London, in Paris, in New York? Where would you want to own the building? Where would you want to own the bar of gold? It turns out that everywhere in the world, the gold got seized. Maybe you might have got by in Zurich, Switzerland, but everywhere else you lost all your money. Every bank failed, every currency failed. So your best bet is maybe you own property that they can't make more of. If you're lucky enough to own, if you owned a piece of property on the Gold Coast of Florida for 100 years, it went from $100,000 to $50 million. Good, but the property taxes on it probably offset the capital gain from it if it was residential. So the only way you could have actually made money owning property is if you own commercial real estate and you generated a rent on it in excess of the taxes and the insurance and the depreciation and the maintenance. It's not easy to do that everywhere in the world. So Bitcoin represents property rights, or the right to purchase perfect property that is maintainable, right? It's low cost to maintain. It's indestructible. The rain doesn't melt it. Tornadoes don't destroy it. And it's scalable. You can buy it with your weekly paycheck. And if it's liquid, you can sell it. Try selling it 1/100th of a building. Not so easy. You want to mortgage the building? Well, you can, a building in Kansas City, you could mortgage to a bank that deals in Kansas City real estate. But if you're Turkish and you have a building in Istanbul, there's only just a small number of banks in the world that will give you a mortgage on that. The mortgage will be in lira. The lira is losing 30 to 40% of its value a year. You got a problem. So Bitcoin represents global digital property. You can take it anywhere on earth. You can hold it for 100 years. In theory, you can hold it for 1,000 years. So you can take a very long view. And how many banks will want your Bitcoin? You see what's going on right now is there's a French bank that wants to custody Bitcoin. There's a German bank that wants to custody Bitcoin. There's a Singapore bank that wants to custody Bitcoin. The banks in the UAE are getting into the business. The banks in Spain are getting into the business. The banks in the US are getting into the business. Right? And on the other hand, none of those banks want to give you a mortgage on your house in Arkansas. Only a local bank in Arkansas is going to get into that, right? So Bitcoin represents a pure economic asset. It doesn't have the liabilities that come with securities and other forms of property and other commodities. And it's simple. And that's why it appeals to the middle class. I don't have a better solution for you if you're a working person on a salary and you want to take control of your own economic destiny.